Hey guys, how's it going? Option Sniper here on Dave Santarelli's YouTube channel. Hope you all are having a fine Sunday morning or Sunday afternoon or Sunday early afternoon, I guess, if you're on Eastern time. Alright, so let's get into this. Today we're going to talk about more types of plans, good times looking to enter trades. I did see a lot of people wanted to talk more about managing a winning trade, and I think that's, I know for me that's definitely the most complicated thing to do is manage winning trades. And so it's just always important when you're trading to have rules for yourself and to follow those rules and govern your trading by those rules. And then eventually you'll find you won't be giving back so many winning trades. Because I think what happens to a lot of people winning trades is they end up holding them too long, especially with options. Profits can evaporate so fast with options. And so I think it's important to have some rules so that when your trade becomes profitable, you at least don't end up losing money, and hopefully you can take some profits off the table. So we will talk about that, but some people did want to know about like when to enter trades and such. So I think we have some good stuff to talk about today. Okay, so I actually went ahead and people were asking about strikes expiration dates, and that was kind of a request. So I went ahead and I gave you guys an example of how I would make rules for myself and how I do make rules for myself, but how I would structure kind of rules for myself with a smaller account, and even with no matter what size my account is. Just an example of how the types of rules that I make for myself. And I came up with these rules for everybody that are trading because this kind of governs what expiration dates you're going to be using. Because you should be spread out. Your expirations should be spread out in your account. You shouldn't be loading your account up in weeklies, ever. And so I think we don't talk enough about money management and how to properly manage your account. And so I came up with these rules. Now, this doesn't mean, that everybody has to follow them. I think that if you follow them, you'll have a much easier time managing your money and a much easier time minimizing your losses. So basically, I would follow these rules. This is kind of a guideline that I do like to stick to. Sometimes, if I have a bigger size account, I think maybe you can go a little bit more risky. But I think no matter what, even if you have a big account, this is very good guidelines and very good rules for everybody to follow. So I'm going to explain these to you guys, and then I'll see if anybody has any questions. Okay, so these are some rules that I made for people to follow on strikes and expiration dates. Now, strikes is no matter what expiration you are, I'm going to always say your delta should always be a minimum of 50 on whatever strike that you're buying. So that's pretty easy for the strikes. So your delta should determine what strikes you're picking on the options. And no matter what the expiration, the delta should always be a minimum of 50. So that's easy enough. Now the expiration dates is where it's going to get a little more complicated, but if we follow rules like this, and this is just an example of how I have so many rules for myself that I've made over the years. You just have to have rules on paper that you need to follow that give you the highest probability of success. Because anytime, if you allow kind of human nature and your emotions and your feelings to mix in with your trading, you're going to find that you don't have as much success, and you're going to find that that's kind of when you make your greatest mistakes. And what rules do is rules kind of eliminate, the emotions, the feelings, because no matter how you feel or what you're doing, you got to stick to these rules, and it really helps you not make mistakes that are kind of could have been avoided otherwise if you had some guidelines in place for yourself on paper. So this is going to be for an example for a $10,000 account. How I think everybody should be managing their money all traders should be managing their money on the Saturday exchange, and I even stick to guidelines like this as well. So we're going to take a $10,000 account. Okay, I think 3% max in your account should be in weeklies. Okay, and when you're in weeklies, you should be assuming everything you have in this trade is at risk, which means if you have a $10,000 account, max you should have in weeklies is $300, in my opinion. Okay, now that doesn't mean that the additional trades that go above your 3%, that doesn't mean you can't make those trades. It just means you should go out more in expiration. You can still use the ideas, but I think that you should go out further in expiration and stick to these rules. And that way you're still using the ideas, but you're being less risky in your account. You're protecting yourself more. You're allowing yourself to stay in the game in drawdown periods. And guys, because I'm telling you, I feel very, very, very confidently and strongly that there's going to be a big sell-off this year. And usually sell-offs happen towards the latter part of the year, September, October, August. So I do feel very strongly about that still. And why I'm saying this is because it's so important to make sure that you're keeping yourself in the game and you're not having a huge drawdown before the big sell-off occurs. Now, obviously, there's nothing showing in the market right now that's showing us that it wants to sell off. But besides fundamentals, I'm saying like the charts, obviously nothing showing. But fundamentals, yes, the market's at historic valuations. It's historically expensive. There's a lot of internal economic data that's kind of starting to slow down. Obviously, we're not going to be able to talk about any of that. But I have my reasons for why I think the market's going to have a sell-off this year. Obviously, it's not there. But what I'm saying is by using this money management plan, you're going to allow yourself to stay in the game long enough so you can enjoy a big sell-off, okay? Because that's when you're going to make a shitload of money. So when the market sells off, it's the best time to make money fast in options is when we have big sell-offs. It was kind of like a fake out that we had this past couple weeks. We had one big down day and that was it. Usually that doesn't happen. Usually you get some more follow-through. That obviously didn't occur, and that's fine. And this is why, I'm saying like this money management thing, even if it didn't occur, you'd be fine. And then also if you probably had some profits in those bearish trades, and there might have been people who gave back too many of those profits by not managing their winning trades like they maybe could have. And so we're going to talk more about that too. But these rules, guys, let's just go over them now. 3% max in weeklies, like I said. Now, obviously I just mentioned that doesn't mean to stop making trades, because most of the trades that Dave gives are weeklies. So if you have over 3%, if you have 3% of weeklies in your account, that just means go out longer in expiration. You can still use the ideas. Okay? So 3% in weeklies. Now, another 3% in expirations that are greater than 7 days and less than 30 days. Okay? So that's another 300 max, assuming that everything you have in that bucket is also at risk. Okay? And why I make the big distinction between greater than and less than 30 days. Why do I do that? The reason I make that big distinction is because inside of 30 days is when theta, which is time decay, starts to greatly accelerate, okay? Theta is our worst enemy, okay? It's time decay. It means every day we're holding this option, it's losing value because it's getting closer to its expiration date, okay? Once you get inside of 30 days of expiration, theta dramatically starts to accelerate, okay? And so that's why I make that distinction. And obviously when you're inside of 7 days, it accelerates even more exponentially. So that's why I'm making these buckets. And I hope that everyone can stick to these rules. I think these are good rules to follow. So like I said, 3% in expiration greater than 7 days, less than 30 days. Okay, so that's assuming everything's at risk. And then 5% max in anything that's over 30 days until expiration. Now, with the 30 days plus an expiration, you can assume that only 50% of your position is at risk instead of assuming that everything you have in it is at risk. So what this means is that you can actually have 10% going out 30 plus days because you're only assuming that you're risking half of what you have in it, right? So if you have a $10,000 account, I'm saying it's okay to have $1,000 in trades that are going out greater than 30 days because you're assuming that you're only risking half of that, right? You're assuming that you're only risking half of that 10%. So you're risking 5%. It's okay to do that when you go out further. Now, when you're inside of 30 days, I don't think it's okay to do that. I think you should just be assuming everything you have in that trade is at risk, okay? So this would give you a total risk in options in your portfolio at any time where you're holding overnight is 11%. And so even if something completely bad happens and somehow you manage to lose everything that you have in these trades, which isn't very likely, probably won't, that isn't likely at all actually, but even if it did, you still only draw down your account by 11%, which is very easy. That's an easy, 11% drawdown is pretty easy to recover from. Once you get towards 25% or more drawdown, that's when it's really gets tougher, because when you have a 25% drawdown, it's good. You have to make like 35% to get back to break even. If you have a 50% drawdown, you have to make 100% to get back to break even. Okay, so I think if you can keep your drawdown inside of 15% at all times, that should be the goal. And this is just an 11% drawdown, assuming that you lose everything. And I guess, if something really crazy happened and you lost the full 10% on the 30 plus days, it would still only be a 16% drawdown, right? That extra 5%. But you're not likely to lose everything that you have in the 30 plus days. And even if you did lose most of it, it's still only a 15 or 16% drawdown. If that makes sense. So like I said, if you have too much in weeklies, push back the expiration and the risk. Okay, you can still use the ideas, but just make sure you structure your trades less risky. You really want to avoid having too much of your account in weeklies. Okay, that's like the most riskiest thing that you can do. The most risky form of trading is holding weeklies overnight. I don't advocate that at all for anything more than 3% of your account ever. Okay, it's just way too risky. Day trading weeklies, that's a different story. That's something that I do more of on my own, and we probably at some point will go into that more and cover that more. But right now we're focusing on daily candlesticks and swing trading, holding trades for anywhere for a couple days to a couple weeks. And so if you're holding weeklies overnight, you should not be holding them with a lot of your account because it's just super risky. So let's back out and see if anyone has any questions. Okay, I don't see any questions. I will wait a couple minutes and see if anybody has any questions. That was a nice little... So Odin asks that question about they expired out of the money and they just disappeared. Okay, that's normal. And that didn't show as a loss in the account. Okay, that's not normal. It should show as a loss in the account. So I would contact them and see what's going on. It should show as a loss on the account. And yeah, I don't know why it's not. I would contact them. That doesn't sound normal to me. Does anybody have any other questions? Cutting out. Can everybody hear me okay? I shouldn't be cutting out. I have everything going the way it should be going. I have pretty high speed internet. I hope I'm not cutting out. Otherwise, I'm going to have to contact my internet provider. Okay, good. So nobody has any other questions about that? That's pretty straightforward. It makes sense. Okay, good. Glad to hear that it's on your end, because I recently upgraded my internet to a very fast speed, so I shouldn't be having any issues now. Alright, let's just keep chugging along. Glad to see we have over 15 people in here too. Okay, so the next thing we're going to go over here is how to enter the market correctly. Okay, when we should be looking to enter into the market. And I did do a class last week on the Fibonacci's. We're going to use the Fibonacci's again today, because the Fibonacci's are so important to be able to view the market so that you're entering the market on a pullback, okay? That's the best time to be entering trends, is on pullbacks, not into the teeth of a rally, and sell-offs, not into the teeth of a sell-off, okay? Now, what we've had here the past couple weeks now, after last week's rally, is the market made a almost textbook perfect bullish ABCD pattern, okay? And there's bearish ABCD patterns as well. So there's both bullish and bearish. We're just going to cover bullish because we are in a bull market still. I think it's very important to always step back and look at the overall trend of the market. We'll go over that a little bit as well, so we can just get context. But with last week's move, we've now completed a textbook perfect bullish ABCD pattern on the S&P, okay, on the SPY on the S&P, and on most other indexes as well, and stocks probably look similar, or most stocks look similar. So a bullish ABCD, right? It's right here, okay? A B C D, right? Is it let me see. A B C D, yeah. A, B, C, D. Yeah, we're missing a leg there. A, B, C, D. Yeah, no, we're not missing a leg. Okay. A, B, C, D. That's what it is. So A, B, C, D, right? So it's an ABC correction. So I'm going to show you guys an example. Okay, so when you look at the Fibonacci's, it's most important to look at the most impulsive moves that we get. What was the last big impulsive move we had? Was this move here, right? Now, can anyone see on the chart when the last impulsive move before this one was? I'll give you guys a second. See if you can see where the last impulsive move before this one was. Okay, it should be pretty straightforward. If you think it's here to here, then yes. Okay, that's what you use the Fibonacci's for. You use the Fibonacci's to measure the big impulsive movements. You can also use them to measure sell-offs and corrections, like this ABCD pattern, right? ABCD. You can also use Fibonacci's to measure retracements and see if the retracement's over when it climbs out. You can use it for both. The best way to use it is to use it for the primary trend, okay? We looked at it last week. We looked at the correction. And I said, if we climb up the 618, then this correction's over, which is what happened. But the better way to have looked at it, and that's because this big move here, I assumed that there was going to be more follow through with a 1% downward move. Usually it's not just one, and that's it, but that's what happened this time. But it's better to look at the primary moves, okay? And to look at the primary moves, first identify the trend in the market. The trend in the market is a bullish trend, okay? What I have on this chart, the easiest way to identify a trend is to look at the 50 SMA and the 200 SMA. A bull market can very simply be categorized as a rising 50-day and a rising 200-day, all right? And then obviously the 50-day is going to be above the 200-day, and if the gap between the two is widening, that signals even more strength in the bull market, okay? So the primary trend is we're in a bull market. So we should be looking to enter the primary trend on a pullback using the Fibonacci's, okay? And we did get a good opportunity, and we just corrected this ABCD pattern, right? A, B, C, D. We just corrected it. We just closed out of the 618 of this measurement, which I'm going to go to the next one, and it's going to have the Fibonacci's. But I just wanted to show you guys, we want to measure the primary moves, okay, the impulsive moves, and then enter those impulsive into those trends on pullbacks, right? We're in a bull market, a bull trend, so we want to enter this in on a pullback. Okay, so this is the last big impulsive move we had, and this is what we're measuring, right? And the one before that was this, and the one before that was this. Okay? So this is just zoomed in, and we're measuring the last impulsive move. And what we saw, right, this ABCD pattern, A, B, C, D, we came pretty much right down to the 618. And then now we've closed above it, right? So we retraced pretty much perfectly this move, like a textbook ABCD pattern. We came into the Fibonacci retracement zone. We came all the way down to the 618. We bounced, and now we closed above it, okay? Which shows us that this correction should be over. We should be heading higher now. Probability-wise, we should be heading higher. What we really want to see for confirmation is we want to see us close above this candle. And then basically, when we close above this candle, this move doesn't matter anymore, okay? This move is meaningless now. As soon as the market closes above this level, this move is not, this big move. This is the biggest move we've had in a long time, right? It was like a 1%. It was over 1% move down in one day. As soon as we close above this candle, this move is now rendered meaningless. Doesn't matter anymore. It still doesn't really matter that much either. It still is significant enough to be like, okay, maybe there's some chance that we could come back down and retrace into this zone again, and things start to shift again. But we've retraced down to the 618. We've come out, and now we've closed out of it. Probabilities now tell us we're probably going to start trending higher again. The last kind of confirmation we want from that, like I said, is a close above this candle, because this was the big significant candle on that sell-off day that we had. So this is kind of an example of how we would look at a trade to be entering on a retracement, right? We always want to enter the primary trend on pullbacks, okay? And I'm going to actually give you guys a concrete example using this here, which is just what happened in the past couple weeks. Once we get down to like the 50% level, retracement level, we can start looking for an entry into a bullish trade. We can use the 50% retracement level as an entry, and then we can use the 618, a close below the 618 on the daily as a stop. Okay? If we did that, we would be risking $1.70, right? Because it's about $1.70 here between the 50% and the 618. So we'd be risking $1.70. So another example of a properly planned trade, and we're actually going to go into more example about protecting your profits and managing a winning trade. We'll go more into that. I have a couple rules that you could use. It's really like there's no perfect way to always make sure that you take your profits at the best possible time. It's just it's never going to work like that. You just have to have rules that you follow, and then you have to stick to those rules, and you have to be okay no matter what happens. If the market keeps going in the same direction of where your profits came from, you can't like be upset about that. You actually should be happy no matter what that you decided to follow your rules on your exit of taking your profits, if that makes sense. But we'll talk about that more in a second. We're going to talk about an example of structuring a trade on a pullback of the primary trend. The primary trend is still up. We're still in a bull market. This is the primary trend. Now, this pullback, in hindsight, was a decent time to look for an entry. And we're going to use this as an example of entering a primary trend and entering a trade. Like I said, we would use the 50% retracement as an entry point and the 618 as a stop. Okay? Which we have here. 618. Okay, we're risking $1.70 on the SPY. We're buying a $50 call, so we're risking 85 per contract about. All right, because we're risking $1.70, it's 50 delta, roughly a 50 delta, which means that we're going to lose 85 cents on the contract if we stop out, which is $85 per contract. Our target, okay, whenever I structure my trades, and I think it's a good rule of thumb to follow, and again, I'll just keep hammering everything home like I always try to do. We want to try and make sure that we're doing 2-to-1 reward to risk. because this means you only need to break even 33. You only need to be right 33% of the time to break even. Okay. So if we're gonna do a 2-to-1 reward to risk, we know we should. Okay. Before I go any further, I just want to emphasize again. Before we enter a trade, the first thing we need to do is know what our risk is, know what our stop is. Okay, it's the first thing. Always the first thing to do. Identify the stop, identify the risk, make sure we're okay with it, and then go from there. Right? That's how you structure a trade. You start with the risk. Okay. So we're risking $1.70 on the SPY, on the actual stock of the SPY, right? The actual ETF, not on the options. We're risking 85 cents on the option. We're risking $1.70 on the SPY, which means we want it to climb 340 roughly. So our target should be around 340. Therefore, our target should be 236.70. This is actually a perfect example of a trade because it's about $1 away from our target right now. So how would we manage it right now? Obviously, we don't want to give back our profits of this trade that would have worked. So we have to have some type of rule that we follow so that we don't allow the SPY to come all the way back down and wipe out all of our profits on a winning trade. If that makes sense. So, with that being said, obviously, like I just said, we want to make sure that we guarantee ourselves profits on a trade that's starting to work. Okay? Professionals always take profits. But this is a good example of how to look for a pullback of a primary trend to enter a trade by using the Fibonacci's, which are key price levels. I kind of went into more detail about why the Fibonacci's, like what they're about, how they work, like how they pop up like everywhere in the universe, how the numbers always work in last week's video. But moving forward, we're going to use the Fibonacci's a lot. Okay, so this next slide, we're going to talk about some examples of what we can do to manage a trade, to manage a winning trade, to make sure that when a trade becomes a winner, we make sure that we don't lose money on the trade. And we even want to make sure that we can at least squeak out some type of profit, with giving it enough room to continue to run and make us more as well. So, let's see here. Like I said, it's always important to, it's like, no matter everything in trading, our trading should be rule governed, right? All of our trading, we should have rules for everything. We should be rule governed traders. Otherwise, we're kind of shooting from the hip, and we're way more likely to have setbacks and failures if we don't have rules for ourselves, if we don't have plans, okay? So, like I said, we never want to give back profits. We never want to let winning trades turn into losers, okay? That's like never want that to happen. But with all that being said, there's nothing that I can tell you guys to say, if you do this every time, it will guarantee that you're going to make X amount of dollars and you're not going to lose this. It's not how the market works, okay? You need to make rules. Rules are important, but there's nothing that I can tell you guys that's going to like guarantee that you're going to get every trade on point correct every time. Okay, it's just not how. It's not a mathematical like formulaic guarantee type of. Nothing's guaranteed in the market, so it's like a science. Okay. But the important thing is just to make sure that you have rules for yourself with taking profits that you are okay with. Okay, that's what matters. Okay. I'm going to give you guys a couple examples of some things that I like to use, but this doesn't mean that these are what you should do, okay? It means that these are examples of some things that you could use, or it's examples of some things that you could use as guidelines to make rules for yourself that you're okay with, if that makes sense, okay? So this first one's probably my favorite one. Let's say, like, right now, we're over, on this example trade that we just did, we're over 50% to our target. Obviously, we should definitely be moving our stop up, at least to break even, but I would say even more. Once we get to, like, a 50%, once we get halfway to our target, I will move up the stop so that I stop out when I'm 25% above where I entered, right? So that means I'm going to have a profit, right? So if we're 50% to our target, I'm going to move my stop up 25% above where I initially entered the trade. For example, once we get to plus 170 on the SPY, because our target's plus 340, which is 235, which we're a little bit above 235 right now on the SPY, we will now move our stop to plus 85 on the SPY of 234.15. So my stop now on the SPY is going to be 234.15. We entered, about $1 less than that, or I think it was 233. Well, it was 85 cents less, right? We entered 85 cents less. And so here, now I'm making sure that I'm gonna, if the SPY starts coming back down, I'm gonna make sure that I stop out with profits. Okay. Not only do I not lose money, but at least I'm stopping out with some profits. And I'm actually giving myself a big cushion, so because I want to allow the trade to continue to go in my direction. You could give yourself, like, it's all subjective, right? I could choose to give myself less of a cushion, and then a higher probability of being stopped out, but I lock in more profits, right? It's how much cushion do you want to give the trade? Because the less cushion you give it, obviously, the higher chance you're going to get stopped out and you're going to be taking your profits, but the higher profits you're going to take. If that makes sense. It's basically like, it's risk reward, right? If once we get to halfway to our target, the trade's working out, now we have to adjust our reward to risk. We have to adjust the trade. It becomes like a new trade. You have to look at it like you have to structure the trade again, right? It's like a reset. You got to reset the trade, restructure it again. Now it's like you need to find a way to make sure that you set some rules so that you're not going to lose money on the trade at least. And I like to make sure that I at least take some profits, but I also give it enough cushion to allow it to keep going in my direction. I mean, like you could be like, okay, if you want to give it less cushion and you want to make sure you take more profits, you could say like $1.25, instead of 85 cents. Or if it's $1.25, then if it moves down 45 cents, you're gonna take your profits, if that makes sense. Another like quick example, right, could be like once you get to a 30% profit on the trade, move your stop to break even. Once you get to a 50% profit on the trade, move your stop to 30% profit. So there's another example, just using like percentage gains. But my point is there has to be something done. You have to have rules in place, okay? First off, you need to, like, if you don't already have a document with a bunch of rules on it that you need to follow every day, make that as soon as possible, okay? Second off, like, this right here is, like, the most complicated process of trading is managing winning trades, in my opinion. And I can understand why people wanted to talk about this, because even for myself and I think for a lot of professional traders, this is kind of like the most complicated process of trading is managing winners, because there's no like perfect way. You just have to be okay with whatever it is your rule is. You have to be okay with it, and you have to once the trade's done, you can't be like, oh, I should have held it longer. I wish I did this. I wish I did that. You should be 100% happy that you were actually disciplined enough to follow your rules and not care about what happens after you're out of the trade. You can't always be second guessing everything that you do. Otherwise, again, you won't do well. Psychologically, mentally, everything. So there's a couple examples, but I like the first example. I kind of use that as my guideline. But it doesn't mean that these are the only two things that you need that are possible. The point is, you just need to make sure that you have a rule for this that you're okay with, that you stick to. That's really the point. And there's just a couple examples here. Let's see if anyone has any questions and how much time we have left. Yes, Zach, when you when you measure the fibs on an uptrend, you start at the bottom, right? So this retracement zone that I just gave you guys, you start here, right? You start here, and then you go up to the high of here. So you go from the swing low to the swing high. Swing low to the swing high of the most recent impulsive move, which is this. Swing low to the swing high. All right? From here it would be swing low to this swing high. These are the last two big impulsive moves the market had. And then swing low to swing high is impulsive. And this is kind of an impulsive move too, but this was more swing low to swing high. So when you're measuring bullish retracements, yeah, you do the swing low to the swing high. Last week we did a bearish example. William says, do I believe too many traders don't follow a percentage model because they're unable to purchase a large amount of contracts? Therefore, the profit isn't as great. That could be possible, William. You know, if it's mental, like where it's like it's not big enough dollar-wise, if it's a mental thing, then my advice would be to wait, save up some more money and wait until you don't have that issue anymore. But I can see the point where like if you're playing with too small of an amount of money, the percentages don't really matter to you because it's such a, like if you have a 30% profit and you're only making like $100, it's like you don't care about the percentage because the dollar amount's so small. I can see what you're saying with that. And my advice would just be to save up enough money so that the percentage actually starts to matter. And if you can't, if you're in a position where you have to trade with small amount of money, then don't look at the dollar amount, look at the percentages. The dollar amount doesn't matter. Look at the percentages. If you're in a position where you're only using like a $4,000 or $5,000 account, or maybe even less, the dollar amount shouldn't matter. Okay, the dollar amount should never matter. Use the percentages. Use the percentages, and you'll be fine. Stick with your percentage rules. Make some rules for percentages and stick to those, and you'll be fine. But I can see what you mean. Where like the dollar amount's so small that the percentage doesn't matter, or it's like mentally like there's a mental block there. That makes sense, and I would say the first step is being aware of that. As soon as you're like, the most important thing in the market I feel strongly about is mentally and psychologically. So the fact that you're aware of that is like the first step, right? If you're aware of like that's kind of something that you struggle with, then you can put things in place so that doesn't happen. And being self-aware, if you're not self-aware in the market, you're destined for failure, in my opinion. So like that self-awareness where you're saying struggling with XYZ, at least that's the first step. Now you know like that's something that you're struggling with. So put some stuff in place so that you don't allow yourself to make those mistakes. That's the next step. Yeah, that's the advantage of a live stream is we can do a lot of Q&A. That's what I'm here for. I want to coach you guys up and answer all your questions as much as possible. Yeah, Zach, the daily chart's the best to use the fibs for. Yes, I would use the daily charts. Douglas, yeah, I mean you could use some Bollinger Bands intraday if that's kind of what you want to do. It doesn't really matter what it is that you want to do. Just make sure that you have those rules in place. Is I guess my main point. Just make sure that like our number one goal is to protect our capital, right? So make sure that when you have a winning trade, you're protecting your capital. Like put some rules in place so that the winning trade stays a winning trade, okay? It's more important to take profits out of the trade than it is to try and let it run longer to make more, okay? Don't get greedy. Just make sure that you have some rules so that you're going to take your profits when you have them. Or so that if the market shifts, you're at least going to take something out of the trade where you made something. But yeah, I mean, there's all types of things you can do. If you want to use the Bollinger Bands, that's fine. You know, just structure some rules that make sense. Go back and look at stuff. And, you know, the important thing is that you have rules. Yeah, Panda, when you're doing a bearish one, you start at the top. You start at the swing high to the swing low. So when you're doing a bullish Fibonacci, you start the swing low to the swing high. And when you're doing a bearish, you do the swing high to the swing low. Yeah, daily charts are the best, Zach, in my opinion. You can use intraday. I would use intraday if you're like, you don't need to use intraday unless you're day trading, really. So yeah. Let's see. So we have about 20 minutes. We have about 20 minutes left. So that's good because I wanted to talk about volatility last week, but I didn't get to talk about volatility at all because we talked so much about the Fibonacci's. Does anyone have any other questions? I'm going to start talking about volatility here unless you guys have any more questions about what we just talked about. Otherwise, I'm going to move on. So please feel free to ask anything. Type anything in the chat. That's what this is for. This is like a live thing, live interaction. So please feel free to type any questions you have in the chat. That's right. I mean, volatility is like the number one thing for options traders, volatility. So give it like a minute here. If nobody has any other things that they want to think of to ask, then we're going to move on. And I will share this PowerPoint as well with you guys when we're done. I'll share it in the Cinderella Exchange chat. Doug asks, how do you manage the buying when the option spread is big? You mean the bid-ask spread? Is that what you're talking about, Doug? My advice would be don't trade. So I have a rule where I don't trade options on stocks that have a bid-ask spread of greater than 5%. So example being, I guess you could say 10. I would say 10%. Example being, if it's a $1 option, and the bid ask should be a max of $90. If it's anything more, if the bid ask is anything more than 10%, I wouldn't trade them, just because they're not liquid enough. And then you should be looking to the open interest. Whatever options you're trading, you should be looking to the strikes with if it's not as liquid, meaning the bid ask is higher. You should be looking to strikes on those with the highest open interest because that's where you'll find the tightest bid ask. I wouldn't trade anything with higher than a 10% bid ask, meaning on a dollar option, 90 bid, $1 ask. And then how to manage it, whenever we're buying options, we should always be doing limit orders. So that's how you manage it. You should be putting in limit orders always. Every time we're entering an option trade, we should always be putting in a limit order. And I feel the same way about selling. Now, if you're putting in a stop, then I would say it's not as important, in my opinion, to have a limit because sometimes it won't get hit if you're putting in a stop. But if you're actually like selling real time to lock in profits, you should try and put a limit in for that as well. And I would always advocate limit orders. So that's kind of how you manage that. And I would stay away from anything with a greater than 10% bid-ask spread. So like on a $2, it'd be, $1.80 by $2. It's like the max really spread that you want to be messing around with. Because, I mean, the wider the spread, the less liquid the option is, the harder it's going to be for you to make profits, right? Or the more that spread eats into your profits too, into your trade. So, all right. I think we're going to talk about volatility now. Show you guys a couple things. I'm going to explain the VIX a little bit. Okay, so generally speaking, the best time to be trading options, right? The best time to be a buyer of options is when volatility and implied volatility is elevated, okay? The higher volatility and implied volatility is on an option, the bigger the swing moves you're getting in both directions, meaning the easier it is for you to profit, right? So volatility is an option trader's best friend. It's like the number one thing that we need to have the best chance of making good profits on trades. So the VIX, right? The VIX is something that everybody should track daily. The higher that gets, it's kind of like the fear gauge in the market. Right now, anytime it gets above like 14, that's kind of saying like fear is a little bit elevated. It's been like in the 11s and 12s for like a long time. It's been like in the 11s. It's crazy how low it's been. So basically when VIX is this low, it's not as good to be placing a lot of trades, especially short-term trades. It's better to be placing more like longer-term bullish trades when the VIX is this low. Although the VIX did pop a little bit on Friday, but it's still like really, it's still below 13, still low. So how is the VIX calculated? The VIX is calculated by using, it's a forward-looking indicator, right? It's the market's expectation of the next 30 days of volatility on the S&P 500. Okay, it's constructed using a wide range of IVs on the SPX. So implied volatility. If you're trading options and you don't know what implied volatility is, that's kind of like, I guess, I don't know what to really call it. It's like a boo-boo, I guess. It's like a bad boo-boo, right? Or a bad mistake to, if you're trading options and you don't know what implied volatility is, that's not good, okay? So if this applies to you, if you're watching this video and listening to this and that applies to you, please do everything you can to learn about why implied volatility is so important. We're going to talk about it a little bit today. I've talked about it in previous videos. We're going to talk about it a little bit right now, and make sure like implied volatility and the VIX are like so important for option traders to be aware of. And yeah, a lot of people refer to the VIX as just a fair gauge. So the higher the VIX, the more expensive options are going to be because implied volatility is going to be higher. But also the better the moves are going to be that you get, so it's easier to make some profits in those options. So, like I said, when the VIX is low, it's the best time to be buying longer-term options because the market's not having as big of moves intraday, and so it's kind of like more grinding, and so that means you should give yourself more time. But also, when the VIX is very low and IV is very low, this is a very good time to be buying longer-term puts because puts are going to be very cheap, right? Because implied volatility is so low. When the lower implied volatility is, the cheaper the all options are. So like it's the best time to put in, if you think you have bearish stances on the market, it's a good time to be like buying longer term puts, or like if you want to hedge your portfolio, it's a good time to be buying longer term puts when the implied volatility is lower because it's cheaper. And yeah, like I said, when the VIX is low, it's the hardest time to be doing short term stuff in options. Okay. But no matter what, it's why I really advocate 30 plus days in expiration. It's just because it's tough when the volatility is low. It's really tough. It gets tougher, and the odds continue to be stacked more and more against somebody when they go closer to expiration and the VIX and volatility is low, and all that stuff. So where is the VIX right now? The VIX is between 12 and 13, which isn't a big deal. We did almost get up to 15 intraday. But this was the beginning of last week. I think this was Monday when the market bottomed on Monday, right? We got all the way up to 15, but we closed back below 13, and that was it. That's all we had. You see, we've been in this 11, 12 range pretty much for like a while. And so I guess, we are above the 50-day moving average of the VIX. So we are elevated a little bit because our 50-day average is only 1166. We're still well below the 200-day, but we are a little bit elevated on the 50-day time frame, but it's still really low. Anything below 14, I think if the VIX closes above 14, that means it's a better time. That's kind of like the kind of like line in the sand, I guess you could say, of when things start getting more interesting to be doing more trading short term, is when the VIX gets above 14 and closes above there, which it hasn't been for a long time. Not like a super long time, but I mean a while, since December, right? Yeah. So yeah, I mean, where the VIX is right now, it's still, volatility is very low. Anything below 14 is really low. Anything in the 12s or 11s is like super historically low. Basically meaning the market doesn't have a lot of fear in it. Nobody's really that worried, and should be kind of expected for the market to just keep grinding higher, because there's not a lot of fear. Nobody really implies the market selling off or all that good stuff. So when the VIX is low like this, that just signals every complacency, and there's not really much expectation that the market's going to be, there's a lot of risk in the market, I guess you could say. Okay, so implied volatility. I'm going to show you guys a scan from Thinkorswim where we're looking for we're going for like the highest implied volatility stocks, or options, I mean. And these are the best options to be trading short term. Options that have the highest implied volatilities. Okay? It's just, implied volatility is just the estimated volatility of a security, of any stock. So basically, the higher the implied volatility, the more that this stock is moving up and down, the better it is to be trading. Okay? You want to be trading stocks with high implied volatilities. But that being said, it's also a double-edged sword, because there's more implied volatility. You'll lose more when you're wrong, but the upside's greater as well. So here's an example of a scan that I did, right? All I did was the stock with the minimum price of 15, intraday volume of at least 350,000, and I sorted by the Volatility Index, which is, it's basically giving us the volatility on every name, right? So the higher the Volatility Index on that scanner, the better these stocks are to be trading, all right? So the ones at the top, the ones with the highest volatility indexes, those are, assuming that the options on them are liquid enough, those are like the best things to be trading, buying and selling options in. So you see like MPEL's been pretty volatile. You see these names. So this is kind of a list of names that would be the most beneficial for options traders to be playing around in, or to be, buying, selling options in, trading options in. The higher the volatility index on Thinkorswim, you scan for that, right? You scan for that volatility index. I sorted it from lowest to highest, and the higher that index, the better these stocks are going to be trading intraday. And then the IV percentile is kind of like, yeah, I mean, what I found is that the volatility index is kind of more important, at least on Thinkorswim, because the percentile of IV, I'm not sure how that's calculated. I'd have to look into it more. It's not just IV, it's the percentile of IV, which I'm pretty sure is different than just IV. So I think the volatility index is the best thing to be using on Thinkorswim. And, scan from this gives us a nice little list of stocks that would be the best things to be trading. And you see, like, I scanned for this. We have plenty of results, 1,300 results. I'm sure we're going to be able to find a nice list. You'll be able to find a nice list of stocks that have been the most volatile recently, and so good to trade. Now, that being said, I already have a watch list of stocks that I like to trade, and we do have a watch list of stocks that we like to trade on the Cinderella Exchange. I mean, tech names, right? Amazon, Google, Facebook. Those are all good names. They're pretty volatile intraday. I like to trade Win, Celgene, Baba. Those all should have pretty good IV indexes, or volatility indexes, and implied volatility. And these are just names that we're constantly posting in chat during the week, and that I always have on my watch list. Chipotle, right? Chipotle Mexican Grill. Yeah, I mean but this is kind of expanding that. Netflix is another good one. Tesla. Those are all really their volatility indexes definitely showed up in the scan as well, just not at the top. And yeah, so I mean, that's just an example of a good way to scan for stocks that are more volatile. And does anybody have any questions about that? Yeah, everyone sees the VIX as the kind of the fair gauge in the market, Peter. But I mean, yeah, the higher the VIX is, the more bearish that is for the market, right? And so you're just going to get bigger, meaning you're going to get bigger swings in the market. There's a more of a probability that the market's going to be selling off. More people are buying puts. So yeah, when the higher the VIX is, the more bearish that is for the market. And the more fear there is in the market as well. So they're both kind of correlated in there. Yeah, no problem. Does anybody have any other questions? We have about 10 minutes, 10 extra minutes here where I just want to cover any questions you guys have and go over anything else that you guys want to go over, assuming it's not going to take too long. We've been going for about 60 minutes now, or the class has been going for 60 minutes. There, IV and volatility or you mean like IV and the VIX, right? So IV and VIX are like pretty much the same. I mean, they're not very different at all. They're very similar because they're both measures of just volatility. So the higher the VIX is, the higher IV is going to be on everything, or most things, all things being equal. Let's see. Did I have that in there? That's actually a good question. What does the IV have to be greater than for the scans? So it looks like I didn't do that. You could say like IV has to be bigger than something, but what I did was I just wanted stocks that were liquid, and then I sorted by the volatility index, right? This kind of weeded out. This only gave me 1,300 stocks, just these two things. There must have been something else in there besides these two. Yeah, I don't see anything else. But I mean, if you go in the scan and thinkorswim, I just sort it. Like, you can just click this column and sort it by volatility index. It's going to put the highest ones at the top. And then you can kind of weed out, I guess, as you wish and as you want to do. But you see, I sorted by the volatility index ascending, and I kind of weeded out stocks that didn't have a lot of volume intraday and were too cheap intraday. So yeah, I would just sort it by the volatility index, and then you'll see that there's probably like a certain threshold that you don't want to be. You'll see that there's probably like a certain threshold where those stocks shouldn't, like if you go and look at all the Dow stocks, right, the 30 stocks that are in the Dow, those are kind of examples of stocks, or the volatility index on those are like the types of stocks you don't want to be really trading options on that much, in my opinion, as far as like shorter term type swings. Now you could make like longer term bullish bets on them, but like shorter term, you don't want to be trading things with very low volatility index. And I would say, like, if the volatility index is, I would say a good threshold would be 20%. If it's below 20%, you probably don't want to be trading many options on that, especially shorter term. And I'm also willing to bet that probably most stocks in the Dow have a volatility index much lower than 20%. But I think 20% could be a good threshold. Now, I didn't do that in this. I just sorted by volatility index, and all the big ones went to the greatest to smallest. But I think if you want to use a floor, I think 20% is a good floor to use. Yeah, Panda, that's a good question. That's a very good question. My favorite strategy, right? My favorite earning strategy. And I think that we should go into detail for this, actually. We should actually talk about this more. My favorite earning strategy is an earning strangle, profiting off the rise in implied volatility. And you do not, the way the earning strangle works in my strategy is you sell the strangle before the report, right? So you put on the strangle a couple weeks in advance, and you hold up until you hold up until either the day before or the day of the report, and you sell when IV is at its highest. And basically what that trade allows you to do is, because the rise in implied volatility is so great leading up to earnings, that it offsets the time decay. So it's like, yeah, I mean, that's my favorite earnings trade, is profiting from the rise in implied volatility, because going into earnings that implied volatility is going to be increasing, obviously. It's a strategy I've used before, and it's a low risk strategy because you're not holding through earnings. You're putting on the strangle a couple weeks in advance, and then you're holding it up until a couple days before, or even to the day of when the company reports, and selling it, before the report, and selling when IV is at its highest. And a lot of the times you're able to profit off the rise in IV. And if you don't profit, you're not going to lose much because the rise in IV offsets theta. So that's kind of a more advanced. And yeah, it would be. Well, actually, no, it's not. It's not at the money. The strangle is like the deltas are each 30 in each direction, or there are like 30 deltas in each direction for that strangle. And we should actually make a class about that strategy, because it's like my favorite earning strategy, and it's not risky because you're not holding through earnings. Okay, you're holding the strangle to profit from the rise in implied volatility. That's what you're holding it for. And I did mention this to Dave last time, but I don't think he was that interested in it. But if everybody is interested in it, then we can definitely do something on it, because I think it's like my favorite earning strategy. That makes sense. And Netflix is like a really good, Netflix is an awesome stock to do it on. And actually, if you want to do an earnings strangle on Netflix with the strategy I'm talking about, it would be good to, probably this week would be a good time to put that strangle on. And, well, you know what? I'll talk to Dave and see if we can actually post that idea. Because there's just not a lot of risk in it. And if it doesn't work out, you're not going to lose much. So that's the kind of strategies I like. But yeah, I mean, we can talk more about that. Well, I'm good. It's good. I'm glad a lot of people are interested in that. For some reason, yeah, I don't. This is pointless to even mention. But anyways, you guys tell Dave that you're interested in this earnings strangle that I'm talking about, right? It's not designed to be held through earnings, okay? This strangle is not designed to be held through earnings. You sell it before earnings when IV is at its peak, okay? Because after the earnings report, implied volatility collapses. And that's why a lot of the time it's hard to make a lot of money on, well, that's why, if you hold a strangle through an earnings report, you're almost never going to make money, because IV collapses and you need such a big move in one direction to offset your losses in the other direction. It's why I never hold straddles or strangles through earnings reports. But it's a really good strategy to profit from the rise in implied volatility. And I read more about that and learned about it in a book called what's it called? Volatility and Options Trading, I believe it was called. By Jeff Ogden. He has some good books about volatility. That was my favorite strategy I read in that book, and I have used it to make some money. You will make consistent money, and if it doesn't work, you won't lose a lot. So it's my kind of strategy. But you're also not going to make. You're not going to make huge gains, but you'll make some consistent profits. And then sometimes you'll make big gains if the underlying moves huge in one direction before their earnings report while you're holding the strangle. Then yeah, you'll make some good profits still. So yeah, we should talk more about that, because we're in earnings season now, and I think this week's really the time to be using that strategy on Netflix. And we can talk about that, and I can help everyone manage it, and I can kind of show you guys. Here, actually, Monday morning. So tomorrow morning in the chat, I'll lay out the guidelines for that trade. Okay, I'll type it in the chat. I'll give the strikes, the expiration, kind of the strategy behind it for Netflix, because Netflix is in a couple weeks. Netflix is like the big volatility stock that kind of kicks off earnings every earnings season. So I will do that. We can do that from Netflix. And then, Tesla's a really good one to do it on. Chipotle is a really good one to do it on. What else? Win. Amazon. So, yeah, I mean, we got some good companies to do that strategy on. So, yeah, I'll type that. I'll put the strategy in the chat tomorrow morning before. If anybody's new, I'm in the chat every morning, 5:30 to 6:30 Eastern Standard Time. Or no, sorry, that's wrong. I'm in the chat every morning, 7:30 to 8:30 Eastern Standard Time, 4:30 my time, because I'm a beast. Beast! Guys, you know what? It's crazy. Sorry, I like to have fun sometimes, so I just thought I guess there were some people that were upset about the meme I posted, but I guess some people didn't understand. For some reason, some people couldn't understand that I posted a screenshot of dialogue between two black men, and it wasn't me saying those things being racist. It was a screenshot of two people talking, and I actually still think that it was a pretty funny meme, but I can't post memes anymore because someone got offended, and I can't really be myself, I feel like, almost, but that's fine. I'll stay more towards just the market when I'm in chat, and not obviously trying to have any fun. So yeah, I will go over that tomorrow morning in the chat. Be ready. Yeah, I mean, Panda, apparently they were telling Dave they were going to, sue him. And I was like, dude, you can't, they can't sue you for posting a meme, man. Yeah, I mean, I'm sorry about I feel badly that it actually offended someone that bad. But at the same time, I feel sad that we're in a society where everything has to be racist or everyone has to be a victim. That's kind of the big thing that makes me sad, is really that. Yeah, exactly, right? Everyone is like a victim, man. It's just crazy. Something's sexist, something's racist, something, no matter what. Someone's always being attacked and victimized. Yeah, right? Social justice. I'm sorry, Odin, my bad, man. I didn't mean to offend you. Sorry. I offended some snowflakes, apparently. But yeah, I mean, it's just our society these days, most people have trouble handling the truth and dealing with things. It's sad, man. It's really sad. Yeah, exactly. So yeah, I will post that in the chat tomorrow. And everybody enjoy the rest of your Sunday. And it was fun for sure. Right? Isn't that crazy? And the fact that you could even actually believe that person even for a second that they could actually sue you for a meme. It's man, I don't know, dude. It's crazy. So I won't be. Yeah, exactly. I told him whoever's threatening you, they need to be insta banned, blocked. Just get them out of here. People that are threatening you for something that's apparently they were saying oh, I'm gonna sue you, I'm gonna take all your money. People that are that weak, that are threatening you for something that's not even remotely offensive or racist, but they claim that it is, are obviously people that shouldn't be associated with. First of all, those aren't people that are going to have any success trading in the first place. And second of all, they shouldn't be associated with the website to begin with. It's kind of a good way to weed those type of... I mean, that helped us weed some people out, I guess, in my opinion. I hope it helped them weed some people out. Yeah. All right, guys. So that's going to be it for today. Everybody, enjoy the rest of your weekend. Enjoy the rest of your Sunday. I will see you guys in chat tomorrow. And I will put that Netflix strangle strategy in there for everyone that's interested. Have a good one, guys.